When the late, great John Bogle, the father of the index fund, asked me how I could beat the averages so consistently when I was at my hedge fund, I said that I limited my investors and made it like a club where you had to be nominated to get in. That meant I was never overwhelmed with new money, something that often leads to bad investment decisions. Bogle said if everyone did that, they could have much better records too. And maybe that was the real secret sauce of my hedge fund's multi-year outperformance. I know Jack Bogle thought it was. That's why, as a general rule, if you're going to invest in mutual funds, you don't want to be in an actively managed one. The fees are too high, and the evidence that the bulk of them underperform is too staggering. Plus, remember, if you're investing in a normal account, they'll inflict capital gains taxes on you, whereas you control when to pay, at least for the taxes, if you own your own stocks. Individual stocks, you don't have to sell them, you don't have to pay. If you don't have time to run your own portfolio, then I really want you to own a cheap, low-cost index fund that mirrors the S&P 500. This may sound like a real simple solution, but don't overthink it. The whole point of putting your money in a mutual fund is to save you the time and effort required to manage your own portfolio of stocks. That's why I think it's insane when people start owning multiple mutual funds. By its very nature, funds should be diversified. Now, I know there are a lot of sector-based mutual funds and ETFs out there, but there's really no reason for homeowners like you to have any exposure to those. I know it's no one says this. I'm saying it. If you're going to take the time to try to play individual sectors, that time should be better spent really just picking individual stocks. As for ETFs, in most cases, these vehicles are for trading, not investing. Many ETFs rebalance every day, and that can take a real toll on any long-term performance. Of course, there are exceptions here, like the GLD, the ETF I like as a simple way to play gold. And I like the ETFs that mimic the S&P 500. But in general, if you're not a pro and you're not managing a portfolio of individual stocks, you should be very careful about fooling around with most of this stuff, especially those double and triple ones, leverage ones. Those are a nightmare. Don't do them. Here's the bottom line. At the end of the day, I think a cheap S&P 500 index fund is really the least bad way to passively manage your money, better than the vast bulk of actively managed mutual funds. But an index fund owns everything, the good, the bad, and the ugly. And if you do have the time to do your own homework, and again, there's that inclination factor, I believe you can beat the performance of an index by picking stocks yourself. If you don't have the time, though, don't overthink it. Just one cheap S&P 500 index fund is the best way to go.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.